Hi, this is Jason Fink, Director of Research at Graves Light Lenhart Wealth Management. As this quarterly report is also the start of the new year, we'd like to take a little time to review some of the important economic and financial occurrences over the past year, the implications of those occurrences for the next year, and what investment opportunities we believe exist in the current environment. Perhaps the biggest economic story in 2023 was that of inflation. We entered 2023 with inflation in the United States at a year-over-year 6.3%, which was down from a high of about 9% in 2022, but still part of an inflation episode that was the worst the country had experienced since the early 1980s. However, what has made this story such a remarkable one is the manner in which it has been brought under control. By December 2023, inflation had dropped to 3.4%, and much of that increase is due to housing costs, which, because of the complexities in measuring inflation, tend to affect CPI measures with a significant lag. This, of course, was the goal of the Federal Reserve. However, the mechanisms the Federal Reserve uses to bring inflation under control, primarily the increase of interest rates, tends to do so while exacting a significant toll on the broader economy in the form of lower GDP, higher unemployment rates, and usually recession. To date, none of that has happened. The most recent estimate of the U.S. unemployment rate was about 3.7%, which is lower than it has been, save for a handful of times, going all the way back to the late 1950s. Meanwhile, GDP growth for the first three quarters of 2023 is well above the average for the United States over the last 20 years, and estimates of growth in the fourth quarter indicate that trend has continued. That this state of the economy has persisted while inflation has dropped by almost 50% was remarkable and pleasantly surprising. In part because of this surprising state of the economy, the stock market performed remarkably well this past year, with the S&P 500 increasing about 24% on the year. Much of this remarkable run was due to the performance of seven large technology stocks, the so-called Magnificent Seven, such as Amazon, Apple, and Microsoft. The valuation levels of these large firms are quite high, which cause us to recommend an underweighting of their stocks in portfolios. Here we see the performance of several major asset market benchmarks. The dark blue line is the S&P 500, while the green line is the S&P 600, which is an index of small stocks. Comparing these two series throughout 2023 provides a solid synopsis of market movements for the year. In early 2023, small stocks outperformed the broader market. However, the failure of Silicon Valley Bank in March caused concern that the more financially constrained smaller firms may have trouble meeting their funding needs, and therefore we saw a rapid decline in small stock values. As the year went on, the technology firms buoying the S&P 500 continued to appreciate in value, while small stocks treaded water. Only since about October, as inflation appeared to have turned a corner and the Federal Reserve appears unlikely to continue to raise interest rates, have small stocks begun to recover relative to their larger brethren. Since that time, both large and small cap stocks have increased in value, with smaller stocks comparatively outperforming. International stocks, shown by the light blue line, have tended to perform in between small and large cap stocks. Meanwhile, bonds, which tend to move less severely than stocks, have been buffeted throughout the year, primarily by Fed policy. So what are the primary risks facing the financial markets in 2024? Often the most substantial risks are those that are unforeseen, which really is one of the many solid arguments to maintain a well-diversified portfolio. One of the most cited current risks to the economy is the state of a classic economic indicator, the inverted yield curve. The slope of the yield curve is measured in most academic studies by the difference between the yield on the 10-year Treasury bonds and the yield on the 3-month Treasury bills. That difference is what is illustrated here by the blue line. When the slope is negative, in other words, when this blue line is negative, that has historically been a strong indicator of a coming recession. In the United States, it has been a perfect indicator for decades. This indicator has been negative since October of 2022, putting economists everywhere on alert. As mentioned previously, the economy has performed quite well in the face of this important headwind in 2023. It has performed so well that many economists now believe that the Federal Reserve may be able to engineer what industry analysts have come to refer to as a soft landing. This is a remarkably difficult feat to accomplish. Going back to 1980, only in the early 1990s did the Federal Reserve begin to raise interest rates and not have that set of actions result in a recession. Stated differently, in the 4.5 decades since 1980, the Federal Reserve has managed a soft landing exactly once. Further, as can be seen in the chart on the right, even if we knew with perfect hindsight the exact date that the Federal Reserve were to stop hiking interest rates, there would still be a tremendous degree of uncertainty in the possible implications for financial markets. For example, we see that in the 90-year period between 1929 and 2019, 3 months after the Fed stops hiking rates, the most negative S&P 500 decline was about a 35% loss, while the most positive S&P 500 gain was about a 12% increase. Both the risk of loss and the possibility of gain are substantial, even a full year after the final Federal Reserve rate hike. While on average the stock market doesn't change by very much, uncertainty abounds. The S&P 500 enjoyed an exceptional 10 years through 2023. Specifically, the S&P 500 earned an annualized 11.9% above cash, which was well in excess of the 7.1% long-term average return since 1950. To compare the overall returns to these two periods on an apples-to-apples basis, we examine them here on a real basis, which just means that we are looking at things after inflation has been taken into account. We see in this illustration the stock returns over the two periods decomposed into the components that comprise them. For simplicity, let's focus on the dark blue, denoting real earnings growth, and the light blue, denoting the change in valuation components. Look at these components in the 2013 to 2023 period. Each of these items contributed about or almost double their historical impact on the S&P 500's return. Given the elevated profit margins and valuation measures at present, it is difficult to foresee the S&P 500 achieving its long-term average return, much less the experience over the past decade. So what to do? Fortunately, value stocks, small cap and international stocks, are priced based upon much more subdued profit expectations and the attendant valuation. We therefore continue to favor all of these areas for equity exposure going forward. To further consider investment opportunities that do currently appear attractive, we see illustrated here the yields on various fixed income instruments. The blue diamonds are current yields, and the gray bars are the range of the yields for the given instrument over the last 10 years. With the Fed indicating an increased probability of an easing of monetary policy in 2024, interest rates moved lower during the final quarter of 2023. This being the case, yield levels generally remain attractive across various fixed income markets. We continue to favor high-quality fixed income securities. As monetary policy appears likely to ease, we have added to bond securities that carry longer maturities in order to lock in returns over a 3 to 6 year time horizon. Lastly, we have observed that junk bond or high yield spreads relative to treasuries have continued to tighten to levels inside long-term averages. As a reminder, these spreads represent the additional compensation for the inherent default risk of risky companies compared to safe government bonds. While overall yield levels appear relatively high, these tighter spreads, or less compensation for potential risks, have slightly dampened their appeal. We continue to recommend that clients hold a small amount of commodities in their portfolio, both for the benefit of diversification and because research indicates that they provide a partial, though imperfect, hedge to unexpected inflation. Unexpected inflation is just what you think it would be. Inflation that is different than what people think it will be. Every quarter since the 1970s, the University of Michigan conducts random surveys to ask people what their expectations are of inflation in the next year and publishes the average. And I do mean a random survey. Even one of my students at the university received this call last year. In this chart, the blue bars are the difference between the expected inflation that comes from that survey and what inflation actually turned out to be, thus unexpected inflation. The light blue line is the return to the Bloomberg Commodity Index that quarter. As you can see, the two series move together. The commodity index provides a partial hedge for unexpected inflation, but the hedge is imperfect. Recently, with inflation coming in lower than expected, the commodity index has had lower returns, which is in line with its behavior as an unexpected inflation hedge. There are several points we hope you'll take away from this presentation. Notably, the U.S. economy and markets achieved surprisingly strong performances during 2023, and this will shape the environment going forward. If the economic soft landing expected by so many does not occur, markets may be vulnerable given current valuation levels. The mathematics of equity returns points to below average return potential for the S&P 500. By contrast, the environment for value, small cap, and international stocks appears to be more favorable. As a result, our recommended equity exposure deviates from the conventional S&P 500 position. Further, we believe there are attractive opportunities within the fixed income market, especially investment-grade bonds maturing in around 3 to 6 years. Finally, given the wide range of uncertainty, we continue to recommend wide diversification across asset classes with a small commodity position in case inflation proves more stubborn than expected. Thank you for your time and interest. We hope you found this information useful and that you are more comfortable with the positioning of your financial assets. As always, please let us know if you wish to discuss these or any other issues. We're here to help.